the attendees. Okay, so let's give it some time so we gain more attendees for today. Let me just introduce myself. My name is Kiana Daniel, and today I will be hosting your webinar with Orbex. They serve traders responsibly, and we're hoping that with today's webinar you'll gain some insights on how to do your own technical analysis and how to have some successful trading based on technical analysis, which is the theme for today. Okay, let's see over here. We have all our charts ready that we're going to use for today. We have the hourly charts and our stops and limits. We'll give it another few minutes so we have more attendees. Okay. All right, so during the webinar, please feel free to ask any questions. I want this webinar to be completely interactive. And if you find something that you don't understand, if you need more explanations, if you have a question, if you disagree with what I say, feel free just to type in the chat box that you see in your webinar widget and let me know, and we'll try to cover it. Okay, we'll give it a few more minutes until we start with the discussions. Okay, so today we actually heard of the Scottish results, and well, it appeared as we predicted, and the votes came out in favor of unity, which was very good for the British pound, so that was good news. Okay, so I think we have enough attendees to start our topic for today, which is technical analysis and how to basically perform analysis on the charts and what charts to use, what currency pairs to select, what tools to use, and so on. So last week we briefly mentioned and talked about fundamental analysis and technical analysis and the differences between the two. So we're not going to go through fundamental analysis this week, but we are going to talk about more about technical analysis. And so technical analysis, as we talked about today, is the art of using history to predict the future, and we conduct technical analysis on a chart on your Orbex platform. When you download an Orbex platform, you will see charts like this that basically says the price movements of different currency pairs. I'm going to zoom in one currency pair over here so that you're not confused. So for example, let's say we're looking at the pound-dollar pair on a daily chart. So this is what a Forex platform looks like, and the chart basically shows how the pair has been moving throughout the time, and so we are going right now to talk about how we're going to analyze this chart that, if you see it for the first time, may not make much sense. So technical analysis, we basically today, all right, let's get it straight. Today we're going to talk about how to go about the chart and which time frame to choose. Before that, again, as we mentioned last week, we want to know which currency pair to trade, and we talked about it. We gave you 8 different factors on choosing the your currency pair when you want to start trading. For example, this morning you wake up. How do you know among all the 8 different major currency pairs and all the counter currency pairs, which one you're going to choose? We talked about 8 different factors: strategy type, currency pair correlations, relying only on one currency. If you have an opinion on one currency, if you have an opinion on US dollar, some people would just base all their trading on one currency, which is actually not recommended. Another strategy is mixing your portfolio. So basically being more bullish on dollar in one pair, but then again give it some balance by being bearish on dollar in a different pair. And the 5th factor that we're going to cover more widely today is using tools and indicators. So we're not going to cover the rest of the factors, but we're going to focus on the tools and the indicators. So let's start with, okay, let's say you already have the first factors ready. You have a currency correlation, and you basically said, all right, I'm today because, let's say, of the Scottish independence vote, I'm going to choose pound dollar for my trade for today. And then we go to the next level, which is trading the tools and indicators. In that case, let me show you in the chart. Let's say we're trading pound dollar, right? So we say we're going to trade the pound dollar, or let's say actually pound yen, because I already entered a trade on pound dollar. Let's say pound yen, because that's going to be easier, especially because of some fundamentals that I'm not going to bore you with today, or I'll touch upon it a little bit later. So let's say we decided that we're going to trade pound yen. How do we use the tools? First, we're going to decide, let's go back to the presentation, what time frame we are going to choose, we're going to use for our trade. Am I going to day trade? Am I going to use the 15-minute chart? Am I going to give it a little bit more time and use the 4-hour chart? Do I want to enter a very long-term trade, like on a daily chart, on a weekly chart? As you can see on your Forex platform, you can choose your time frame right over here, which shows 5-minute chart. You see, so this basically shows the price movements in action. Every 5 minutes, one candlestick is formed, and you can see the movements more rapidly. This can become handy if you are a risk event trader. For example, yesterday when we were hearing about the boats, a lot of traders were trading on a short-term period. Why? Because as the results of the boat came out, we experienced a lot of volatility, and therefore you could have made some money in a shorter term period than a 5-minute chart, or on a 5 minutes is a little bit too much actually. I wouldn't recommend that, but like maybe a 15-minute chart, maybe a 30-minute chart. This shows the hourly chart, and so on. So we have a range. Usually most Forex platforms, including Orbex, they have a time range from 1 minute to 1 month. And 1 month is the largest the least frequency basically in a chart, and every candlestick is made in 1 month. So for example, for the month of September, this is the candlestick for the month of September. As you can see, pound yen has generally been bullish in the month of September. And for example, here we have a huge bearish candlestick in 2008 during the month of September, exactly a year ago. So we can see how history is actually kind of rebounding. The monthly chart usually gives us the clear, bigger picture view of the market cycles. And as you can see, well, this goes back to 1991 when the chart started printing. And as you can see, normally we can see a cycle in the Forex market. You see how beautiful this is. And a lot of long-term traders, they just like when the market gets to the high, to the top, they get on the downtrend and they ride on it for years, and then they get on the rebound. And well, in the recent years we've been facing a little bit more difficulty, so we didn't see the high as 2008. So right now some analysts are debating that probably we could actually see a rebound to the top, to the high of 2007, because as you can see, pound yen is on a general uptrend, and if we are following the general rule of market cycles, we could probably be optimistic that we could see on the long term more upwards for the pound. So I'm sorry, we're getting a little bit off topic. So this is a glimpse of a monthly chart. So let's say that today you decided to trade pound yen on the 4-hour chart. And I think that was a topic that you received in your email, how to trade and how to do technical analysis on a 4-hour chart. So basically, some people, they would just go directly to their 4-hour chart and they will start their analysis right there and then. I usually do a multiple time frame analysis, which means monitoring the same currency pair, which right now we're talking about pound yen, across different frequencies or different time compressions. So there is actually no real limit as to how many frequencies you should be monitoring, but there are some general guidelines that we're going to talk about. So typically, I'd use at least 3 different periods. 4 or 5 would be a little bit too much. You might get a little bit too much information. Less, you wouldn't know about the bigger picture. So 3 is basically like the good number, the lucky number for the time frames. And a simple strategy for using multiple time frame analysis is the rule of 4. So that means, as you can see here, you first need to decide which time frame your end goal is, which time frame you want to place your trade on. As we said, okay, so today we're going to place on the 4-hour chart, so that is the number 1. And then basically zoom in. So generally the best policy is to start with the long-term time frame and work it down to the more granular frequencies. So today that we're talking about the 4-hour chart, what are the longer time frames that we want to look at to get the bigger picture? Anything above 4-hour. 6-hour is a little bit too close. 8-hour is still too close. I would go with weekly, daily, and then 4-hour. The monthly, well, you should obviously always know, if you're a trader, as you gain experience, you always want to know what the general trend is about. So that is something that you have to have in the back of your head. Then we're going to look at the weekly chart. What does the weekly chart over here tell you? You see the pound during the past, so since 2012 in May, we started an uptrend. So the pound was going down, was going up on the weekly chart, and then we had a period of consolidation. I hope everybody understand the terms that we're talking about. If you don't see the uptrend over here, you can always use a moving average so to give you more clarity about, let's have a moving average over here so you see what I'm talking about. So this line, basically, if it's going up, we are having an uptrend. If it's going sideways, we are having a consolidation, right? So a consolidation is a period of indecisiveness. If you don't see it, you usually can, like you can use moving averages to determine the uptrend, the trend of the market. You can use lines. So for example, you can get the high over here when you see that the market reached the top. You can get the high and have a horizontal line over here, and you see that the market is actually basically moving between these two ranges and not moving that much, right? It's as if the pair has been moving inside a box. So the pair was consolidating for a good, since, when is this? This is like the beginning of 2014. Since January of this year, we've been having, on a longer term, we've been having a consolidation, but as you can see this month, the pair suddenly broke above this resistance level, and now we're seeing some up moves. So this was a very good time to probably enter a market, but we still don't know. Why? Because this is just a weekly chart. We need to know what exactly the market sentiment is about. So that is why we moved down to the next time frame, which we decided to be at the daily chart, right? In the daily chart, you see the uptrend is more visible. So when you go to when you zoom into the weekly, to the daily chart, to the smaller, shorter term time frame, you see that the lines that you made probably weren't as accurate, right? So that is why when you move down to the daily chart, you want to adjust your the lines or anything that you had already inserted in the time frame. So I'm not going to insert a lot of things right now because first I want to show you how to move around the time frames. Then we're going to go back to the weekly chart and start adding more and more tools as we get used to and introduced to different tools that we can use for our technical analysis. So here's the daily chart. We can see the market broke above it, especially yesterday with the referendum vote. Today we had a huge rise, and then the market actually went back down. I wonder why that was, what that was about. But so the market is basically testing all the way up to, let's see what, hold on one second, I cannot quite see. We need to move our chat box. Okay, so it went all the way up and it tested 180 level, which is, if you go back to the weekly chart, you will see that this level is, wow, how many years? This level is the last time pound dollar was 180 was here in 2008. So that was a huge up move for pound yen. So going back to daily chart, we can now start doing more analysis over here. So there's actually not much. We can use some indicators to see what was the reason that the pair is going now back down. So I'm going to introduce you to one of the indicators that I use a lot, and that is called the Ichimoku Kinkohyo. That is a Japanese indicator that I'm very fond of, and it was invented by the Japanese. We're going to talk about it more, but basically what you need to see here, don't panic. I know that there are a lot of lines now added. Let me clear the moving average so you're not, which one is the moving average right here? There's so many lines over here, which is still fine. The moving average is almost invisible now. Oh, that should be it. Let's delete the moving average. Okay, so now we have the Ichimoku indicator, which also shows more uptrend. Let me give you, we're going to go back to Ichimoku later because, again, let's first cover the downsizing the time frames. So after we, again, on the daily chart, we see we have a general uptrend, but the market has been testing different time frames. We want to go at different prices. We want to go to our end goal, our end goal time frame, which was the 4-hour chart. Wow, so here you see it crystal clear that the market started to go up, but now it actually has started a new downtrend on a 4-hour basis. Are you guys with me? Let me see, check and see if we have any questions. If you have any questions, please post it. If I'm going too fast, if you don't understand why we're seeing different kind of prices in different time frames, please ask a question. So is everybody with me? Let's move back to the daily chart to see how this is helping us. On the daily chart, we were on an uptrend, but we saw this testing level. We saw the shadow that the market started up very passionately going up, but then it went back down, and now actually it's going down. So on a daily basis, if somebody wanted to trade pound yen on a longer term, as I actually have a position for the pound, not versus the yen, but versus a different currency, I would still remain in my bullish position on a longer term period. But if I want to get out of the market shorter, like earlier, and I want to trade on a 4-hour chart, that probably is not a good strategy. Why? Because as we can see here, the uptrend has briefly been paused, and we can see a start of probably a new brief but a new downtrend. This could be even better probably for a shorter term trader, like an hourly trader. If you go even further down, you see now we're on an hourly chart. I did this because even though I said 3 time frames would be better, but today we had an exceptional situation with all the fundamental and the risk events going on in the market volatility. Sometimes it's actually best to check in with shorter time frames than your end goal as well to see what's going on. What is going on here? Of course, it's Friday, and it appears that the market is actually consolidating. So it may actually not be the best time to make that very short-term trading decision. So an hourly basis trading right now might not make sense because the market is just going sideways. That is probably because the UK market is coming to an end, and people are just very excited about the weekend, and neither the bulls or the bears are talking about trading. But at the same time, on a shorter time period, I'm seeing that the Tenkan line and the Ichimoku has crossed below the Kijun line. We will go over that, but this basically the faster the Tenkan line, which is the gold line over here. I'm going to give you a brief introduction right now because I'm talking about it a lot. So actually, yeah, let's pause and talk about Ichimoku for a bit, shall we? Let's get a poll over here. Has anybody ever used Ichimoku for their trading? A lot of people would say no because probably it sounds funny, but especially if you're not Japanese. If you are Japanese, you probably really would understand what Ichimoku is, and you would be a fond Ichimoku trader. But Ichimoku Kinko is a combination of a bunch of moving averages. I'm going to erase this line as well so you're not confused. So when you insert an Ichimoku cloud, you see, look, 1, 2, 3. Let me highlight it over here. So we have 1, 2, 3, 4, and 5 moving averages. These two, they come together and they make the Ichimoku cloud. You see, this looks like a cloud, right? And when it's blue, it generally signals an uptrend. When it's red, it generally signals a downtrend. So there are obviously Japanese names for all these moving averages. They have English names as well, but they're mostly referred to by their Japanese names. So this is called the Chikou line. Chikou in Japanese doesn't mean a chick, it means a delay. So if you look closely, you can see that this is not actually a moving average. This is a delayed version of the prices right over here. You see, this is exactly like this. So this is the Chikou line, and we're going to get into it why we have a delayed line showed on an Ichimoku Kinkohyo, which, by the way, Ichimoku means a look at the chart in a glance. So even though it makes it very crowded for an unexperienced trader, for me, a chart without an Ichimoku looks naked. So the first thing I do, I just always insert the Ichimoku indicator, and then I started conducting my analysis. So that was the delayed line. And then we have the Tenkan line. Tenkan, which is showed here in gold, is the turn line. So this is the faster moving average. Okay, and then we have the Kijun line. Kijun in Japanese means base. This is the slower moving average. I'm not going to go into the calculations of the moving averages, but as you can see here, it says Tenkan line TL, and then you see KL, which is the abbreviation for Kijun line, and so forth. And here the numbers over here basically shows the number of the days these moving averages were divided by. So we have not the day here. This is an hourly chart, the number of hours, or the candlesticks, the time, the periods. So each of these moving averages were calculated by a 9 period, 26 period, and 52, which is the delayed one, right? And then we have the cloud, which is the most obvious one, which is the space between these two moving averages, right? So this is the Ichimoku Kinkohyo. And actually, let me give you a little bit. Maybe I just realized you might not understand what I meant by the 26 and the 29. So the Kijun line, or the baseline, the blue line over here, this is the average of the highest high and the lowest low within the past 26 candles, right? So from here, you count like 26 candles, and you don't need to do the calculation, but this line shows that average. And then the Tenkan line is the average of the highest high and the lowest low within the past 9 candlesticks. That's why this is the faster moving average, right? So now that you know what this Ichimoku is telling you, we have to, what the Ichimoku cloud, the Ichimoku Kinkohyo is about. I keep mispronouncing this indicator myself. It's not Michimoku, it's Ichimoku, right? There have been time-tested interpretations for this indicator. So basically, the main signal you want to get from an indicator is, should I buy or should I sell? And as we have said before on Orbex education and in our previous webinar and our market updates, we say it over and over again, you should not base your analysis only on one indicator, because if you do that, it's just idiotic. But it just gives you a signal. It's a sign. It's never confirmed or 100% correct. It just helps you with your overall analysis. I cannot say that enough. You should always keep in mind that you should never use only one technical tool or any tool, any kind of analysis. You should always combine technical analysis and fundamental analysis, market sentiment, your own risk appetite, your own capital analysis, and then place a trade, because we don't want you to lose money, and the more money you make, the happier we are and you are. So keep that in mind. I'm just focusing on Ichimoku right now. This doesn't mean that I base all my analysis on Ichimoku. Okay, so that being said, back to the signals that Ichimoku can give us. It's very simple, actually. I'm going to, I should have actually typed it out, but I'll just show the signals over here maybe. Okay, let me just spit it out. All right, so a buy signal generally is when the prices are above the Ichimoku cloud. As you can see here, the market is probably in a general uptrend. We have it here right now. The prices are above the Ichimoku cloud. Okay, so that shows me that even though the market has been pulling back a little bit, it probably is immature, and it could be just a test. It probably is not a determination of an overall trend. Okay. Another buy signal is if the Chico span crosses above the cloud. So we have that before. Let's show you, right? Okay. So over here, this morning, this chart is showing. Yep, it's what time frame it's showing. I think it's showing Eastern time. So that's my. If you're out in the UK, you probably are having a different time. But right now in New York, where I'm located, it's 11:30 a.m. And yesterday, no, it's on September 15th. The Chico span broke above the Ichimoku cloud. You see right here? Let me put the spotlight back on. So the Chico span broke above the Ichimoku cloud. So back then, an Ichimoku trader could have seen the signal that, oh, the Chico span broke above the Ichimoku cloud, so this could be an indicator that the market goes up, will go up from here. And guess what? The market did go up, and we saw an uptrend. So that's interesting. That could be a signal. Another signal that you can use as a buy signal on Ichimoku is if the Tenkan line, the gold line, crosses above the Kijun line. Let's see what's happening right now, because that was the catch today, right? The catch today is that, let's put the spotlight back on, the Tenkan line is actually not crossing above the Kijun line. It is crossing below the Kijun line. So there you have it. We're having mixed signals because the market is above, the prices are above the Ichimoku cloud, but the Kijun line is crossing below the Kijun line. So on a hourly basis, this is giving me mixed signals. I'm probably not going to trade on an hourly basis. Let's go back to our end goal, which was the 4-hour chart, right? So we're going back to 4-hour chart, but the good thing that we checked the hourly chart was that we got a better sense of the market sentiment. Now we know that the market sentiment is less volatile and that the traders are not that passionate. We are seeing like some moves over here, but actually the reason why it's Friday, I probably shouldn't have chosen the pound-yen pair, because guess what? The Japanese market, the Asian session is already over. So no wonder that the market is consolidating. Actually, that being said, we probably should move to a different currency pair right now, because this can be an indicator that, you know what, on the Friday at 11:30 a.m. in New York, I probably shouldn't be trading pound-yen on a short-term basis. I insist, again, on a short-term basis, it's not a good idea because I'm not going to see much volatility. On a longer-term period, yes, fine. I'm going to go back to a 4-hour chart. On a longer-term period, I'm going to, now that I have a better sense that, okay, on an overall view, we are having an overall uptrend, right? Let's give a review of what we had before. On a daily chart, we're having an overall uptrend, right? On a weekly chart as well, you're seeing a start of a break above a long consolidation over a few months. So the pair is going to move up. I'm not going to say gonna. The pair is probably going to move up, all right? And the best time frame to trade it today is the 4-hour chart. Why? Because we can see the specifics of the pullback. And we can use a very powerful tool for technical analysis that we mentioned last week as well, which is called, drum rolls, let's see if anybody knows about it. Can anybody guess what powerful tool I'm talking about? Let's take a look at our chats. Any questions up until now? Any thoughts of which tool I'm talking about? I'm going to count to 10. 1, 2, 3, 4. Just give me your thoughts. Any tools that you think I might be using right now that you've heard about before. And if you were present in our last week's webinar, you heard about it. And I did mention that it's my most favorite technical tool. Any ideas? We need more collaboration here. Okay, people are shy over here. All right, so the tool that I'm going to use is Fibonacci. Fibonacci is one of the most powerful technical indicators, and I actually have a lot of not useful information about Mr. Fibonacci himself. Let me give you a brief background about him so that you'll become more fond of him as well. So Mr. Fibonacci, who is the inventor, who actually, all right, let's get it from there. Mr. Fibonacci's real name is not Mr. Fibonacci. His real name is Leonardo Pisano Bigolo, as far as I remember, and his nickname was Bigolo, which means good for nothing. And his dad used to call him that because obviously, as for most geniuses, his dad thought he is having mental disabilities. So he called him Bigolo, which means good for nothing apparently, and hold on, in Italian. And he was very fond of numbers, and he introduced a lot of different sequences in the mathematical world, including introducing and replacing the Roman numbers. You remember those weird-looking Roman numbers, to what we see today as these kind of numbers to the West. So that was Mr. Fibonacci, and he also introduced a sequence that I'm not going to get into the technical parts of it as how the sequence works, but the most important thing that you need to know about Fibonacci's retracement that we're going to use right now is that there are some, this creates levels for our trades. So whenever you're not sure how much the currency pair is going to pull back, how much, like we're on an uptrend, but I'm not sure, I'm seeing a bit of a rebound, but I'm not sure how much it's going to go. That is when Fibonacci comes to rescue. And the most, let's say, trusted levels of the Fibonacci sequence are this one, the 50% Fibonacci. Let me just put it right this so that you can see it better. Right? So this is the 50% Fibonacci level. This one, right? Right here at 174.74. Did any of you guys have a question how I drew my Fibonacci retracement? Nobody asked me. If you don't ask, I'm not going to respond. Okay, just kidding. I'm going to respond. So there is one main way to draw a Fibonacci retracement on your chart? Basically, you identify a trend. Today, going across different time frames, we identified an overall uptrend for the 4-hour chart, right? And then we saw a pullback. That is when we want to use the Fibonacci. And what we do is we identify the bottom of that trend when the trend started, right? The trend didn't start here. The market was consolidating over here. The trend started here. And then it went all the way up. We saw a lot of bullish candles over here. It went a little bit back down, but then it went back up, right? And then we're seeing 3 strong bearish candles. So that is when we want to end our Fibonacci. Let me draw it again. I'm going to erase it and draw it one more time for you to see how exactly I drew it. So different platforms offer different ways of drawing it, but the basic theme is this. You place your mouse at the bottom of your chart and you drag it. You drag it all the way to the top. So a common question is, so we see the chart, the bottom actually could be even this one, right? Here, over here, let me show the spotlight. We have a shadow that the market tested the higher price. Over here as well, we have a shadow that the market tested this level as well. So some people, they completely disregard the shadows of the candles and they go from the bottom of the candlestick, like the certain definite bottom, to the certain definite high. Some other people argue that no, you could actually go back and forth. I basically usually say I play around with it and I see which one is going to fall with my other tools that I would use. What are the other tools that I would use? I would probably want to draw a support level, see what other levels I can identify over here that can help me. Okay, so let's zoom a little bit more out to see what are the technical levels over here. Look at this one. This is very interesting, right? Over here, you see what I'm doing? We have a top over here, and we have another top in an exact same level. And then the market broke up. So first of all, this shows me that it proves that we are in a general uptrend. Okay, the market tested this level twice. It wasn't able to break above it before, but then it broke above it over here on September 11, apparently, at 9 a.m. Okay, so this level is an important level. Now that I have a Fibonacci level, I have different Fibonacci levels, but they don't fall exactly over here. So what I'm trying to say is, even though I drew my original Fibonacci from the exact bottom to the exact top of the market, I am going to play around a little bit and use this one. Use the shadows to see if that will change the levels and give me a better indication if it falls with my other levels. Oh, look. You see the 61% Fibonacci level came higher up. You see where I'm going? Let me write down what I'm meaning by the 60% Fibonacci level. Is the blue line over here. It says 61.618, and this is the price. For short, we call it the 60% Fibonacci level, right? Because the retracement goes all the way from 1 to 100, so it's the 60%. The 61%, I'm sorry. Let me say the 61% Fibonacci, right? The blue color. So what happens now is that because the 61% Fibonacci level is very close, actually, if I look more closely, yeah, I mean, this is a level, this is a range. This top, the market was testing over here, the market was testing over here. So this range over here between this previous resistant, now it has turned into support, and a Fibonacci, right? So this shows me that this is a very important level. There is a possibility that the market goes all the way back down to here and then shoot back up. So the basic thought behind Fibonacci is that when you're in a general uptrend, the market sometimes get exhausted. It goes back down. This also falls back to our general thought of market cycles, right? Market cycles says that the markets go in cycles. They go back, they go up, they go down, they go up, they go up. That's what they do. And most of the times they go down when you're in a general uptrend. They go down to one of the Fibonacci retracements, and then they go back up again. Okay? So today we had the 61% Fibonacci as a very strong level. But at the same time, because of all the things that are going, I don't want to take that risk because of my own portfolio. I'm going to move, actually, I'm going to go back to the daily chart and see what it tells me. Again, over here, we see that this level is pretty important. But in a daily chart, we also see that this level is important as well. You see, we had a top over here that the market tested. So I'm going to add this line using the daily chart to have more clarity on my analysis. You see? So going back to daily chart, this is why it's important to always zoom in and out. It shows me that the 50% is also a very near-term important level, right? And because the 50% generally is more powerful than 60%, I would probably go back to my 4-hour chart and set my limit over here. So this is basically what we're coming down to. If you trade without stop and limit, stop it right now. Every time you trade, you should always know where you're going to, when you're going to take risk, when you're going to say, okay, it's enough, I don't want to have more losses, or you're going to say, it's enough, I don't want to have more profit. You would say, oh, who would ever want to say, I don't want to have more profit? But the fact is, if you're too greedy, especially when it comes to Forex, because of all the volatility and the sensitivity of the currencies to global international news, every time somebody goes up, you get a lot of volatility that more often than not is quite impossible to forecast perfectly. For that matter, you always need to set your stop and limit. What do we mean by that? Is that, I'm sorry, this keeps coming up. I obviously, you notice that on my 4-hour chart, I am going to place a bearish trade, right? On a 4-hour chart, we're going to place a bearish trade, and I'm going to think, I'm going to start, based on my analysis, the pair is probably going to go back down to one of these Fibonacci levels. So you can have a larger risk appetite and set your limit to all the way down to this level, somewhere between the 61% Fibonacci level and this support level. A little bit less risky move would be somewhere between the 50% and this resistance level. And a very conservative move would be placing your limit at the 38% Fibonacci level. And because I'm a very conservative trader myself, I would probably do that, right? So I'm going to place a trade. I'm going to have an entry order. Oh, before that, we talked about limit. We also have to talk about the stop, right? So how do we know how much profit, how much loss we're going to endure, right? I don't want that much. So if the market starts going back up, I want to get out of that market as soon as possible. Some people, they want to stay in the market as long as possible and get that profit. It is important to look at your own portfolio and see if you take that much risk, are you going to get wiped out? If you have other positions, you may not be able to actually handle a lot of risk. So for me, I'm going to this could be a good pivot point. So up from here, the market tested this level, it went back up, it went up, but then it was going up, it was on the way up powerfully, but then it started suddenly turned back down. So this could be our pivot point. What I mean by pivot point, I'm going to show it in orange, which is actually the color that we use for your Orbex market updates as well. If you're not watching it, go to orbex.com/webtv and you will see a chart like this. We do our market updates twice a week, and I give you my own technical analysis together with fundamental signals for you guys. So this is what I usually do. So the pivot point is in orange, and by pivot I mean if the market is going down right now, but if it suddenly decides to go nuts and go back up and cross above this pivot point, then probably my analysis was incorrect. I know it's very hard to admit, but every trader has to be responsible and admit that, okay, I made a mistake. Let's move on. Let's get out of the market. Let's get on a different trade. Okay. So if the pair crosses above this level, that shows that the analysis was incorrect and the market was not able to go all the way down to the Fibonacci levels. Okay. So now here I have my numbers, right? Right now is where I want to place my order. The 38% Fibonacci level is where I conservatively want to take profit, and I would get out of the market and I cut my losses short if the market breaks above 179.87. So I have all the numbers over here, so it's going to be easy for me to place my order. So we have the pound yen. Am I going to buy? No, I'm going to sell, and I'm going to click on advanced because I want to set my stop and limit, and we have the numbers, right? So the stop needs to be bigger than where I'm going to place my order, so that we already know the stop. We already calculated. It's the pivot point at, let's write it down, 179.817, right? Oops, we placed it in the wrong. Let's close it and open it one more time. Stop and limit. So my stop loss is going to be 179.817, and my limit where I take profit is the 38% Fibonacci, which is 176, right? 176.349. That is where I'm going to take profit. Okay. And I'm not buying, I'm selling. Oh, we made a mistake again. We have to okay, one more time. We're going to sell. My stop is 179.817, and my limit is 175. No, it's 176. The numbers are pretty small over here. 176.349, or 350 to round it up, right? I want to take profit sooner than later. Leverage is something we're going to talk about later. I'm not going to put any right now because we haven't talked about it. Hopefully we'll talk about it later. So I'm going to place my order and see what's going to happen. Oops. Okay. So that's that. That is how we placed an order and analyzed a specific currency pair on a 4-hour chart. Let's go and make a summary of what we learned today. So today with Orbex, we talked about, we reviewed what technical analysis is from our previous webinar. We picked one of the methods to select the best pair in Forex, and that was tools and indicators. And we talked about how to trade different time frames, and that we should use at least 3 different time frames. Start with the long-term time frame and work it down to more shorter-term ones. And so we went from long-term, medium-term. One thing I forgot to continue talking about was the rule of 4, which meant going from long-term, medium, short-term, and putting it all together. We definitely put it all together. We went back and forth between the different time frames, and we made our trading decision based on our strategy. We set the stop and limit. We used the most powerful technical tools. Today we used moving averages. We used Fibonacci. We used Ichimoku. We didn't use RSI and Bollinger Bands. We will talk about them hopefully in the next webinars. And we also used support and resistance levels. So, and we successfully placed an order. So we have 3 minutes late. I haven't had a single question from you guys, so I'm assuming that everybody was completely on track with everything that I said, but I'm going to give this final 3 minutes for questions and answers. If any, please don't be shy, and if you disagree even with my technical analysis or anything that we had, just let us know. We would like to hear. It's a crowd trading. It's always good to bounce ideas, even if you are unexperienced. It's always good to hear ideas, and it's always good to trade with people. Personally, I really like it when 2 people trade together, because there's always something that they can see that you can't. And when you're trading, it's important to be open-minded and not be strict to your own, not having an ego, basically. Let's put it that way. It's very important when you're trading, and realizing that you're in a losing trade, for example, or you made a mistake, and moving on as a true trader's mentality. So with that, we didn't get any questions. So with that, I'm going to conclude today's webinar. I hope you're going to have a fantastic weekend and you learned a little bit about technical analysis, and I hope you'll trade responsibly and make a lot of pips trading with Orbex.